$250,000. That's the number that's supposed to change your life. That's the number that's supposed to mean freedom, early retirement, a paid-off house, a future where money stops being a problem. But here's the truth nobody wants to tell you. $250,000 invested the wrong way won't set you free. It will quietly, slowly, and painfully wreck your financial future, and you won't even see it happening until it's too late. This is Ron. And on this channel, we don't sugarcoat money. We break it down so you can actually win with it. Before we get into exactly where $250K goes wrong, do me a quick favor. Hit that like button right now. It genuinely helps this channel reach more people who need to hear this. And if you're serious about building real wealth and avoiding the mistakes that trap most investors, hit subscribe and turn on notifications because this channel is built for you. Okay. Let's get into it. This is where $250,000 goes wrong. Let's start with an uncomfortable fact. Most people who hit the $250,000 mark didn't get there by accident. They worked for it. They saved for it. Some of them sacrificed for years to reach it. And then they lose a huge chunk of it. Not because the market crashed, not because of bad luck, but because of decisions they made with their own two hands. Let's break down exactly how this happens, one mistake at a time. Mistake number 1, putting all the eggs in one basket. This is the single most common way $250,000 gets destroyed. Someone gets excited about one stock, one sector, or one sure thing, and they pour 40, 50, even 70% of their portfolio into it. Maybe it's their own company stock. Maybe it's a hot tech name everyone's talking about. Maybe it's crypto. It doesn't matter what it is. Concentration is concentration, and concentration is risk. Here's the math that should scare you. If you put $150,000 of your $250,000 portfolio into a single stock, and that stock drops 60%, which happens more often than you'd think, even to safe companies, you just lost $90,000 in one move. That's more than a third of your entire net worth gone because of one decision. Diversification isn't boring for no reason. It's boring because it works. It protects you from the one bad bet that can undo years of good decisions. Mistake number 2, investing everything with no emergency fund. This one is silent, but it is brutal. Someone builds up $250,000, throws every single dollar into the market, and keeps zero cash on the side. Then life happens. A job loss, a medical bill, a car that dies at the worst possible time. And now they're forced to sell investments, often at the worst possible moment, when the market is down, just to cover an emergency that a basic cash cushion could have handled. This is called sequence risk, and it is one of the quietest wealth killers out there. Selling investments during a downturn to cover an emergency doesn't just cost you money. It locks in the loss permanently. You never get that money back working for you again. A real emergency fund, 3 to 6 months of expenses, sitting in cash or a high-yield savings account, is not wasted money. It is the insurance policy that protects the other $250,000 from ever being touched at the wrong time. Mistake number 3, ignoring fees until it's too late. Here is a number that should genuinely upset you. A 1% difference in fees over 30 years on a $250,000 portfolio can cost you well over $100,000 in lost growth. Not because the fee itself is huge each year, but because that fee compounds against you every single year for decades. High-fee mutual funds. Actively managed accounts that underperform the market. Advisors charging 1 to 2% a year with no real added value. These add up silently in the background while your statement still shows growth, so it feels like nothing is wrong. But you are leaving a fortune on the table. The fix isn't complicated. Low-cost index funds, transparent fee structures, knowing exactly what you're paying and why. This is one of the easiest fixes in this entire video, and it is one of the most overlooked. Mistake number 4. Chasing what's already hot. By the time an investment is trending on social media, on the news, or in your group chat, a huge amount of the gain has usually already happened. But the emotional pull is powerful. Everyone around you seems to be making money, and you don't want to miss out. So people take a big slice of their $250,000 and throw it at whatever is hot right now. Meme stocks, the latest crypto coin, whatever the headlines are screaming about, right at the peak of excitement, and often right at the peak of the price. This is called performance chasing, and it is one of the most well-documented ways investors underperform the very market they're invested in. Study after study shows that the average investor earns less than the funds they're invested in, simply because of bad timing, driven by emotion. Discipline beats excitement every single time over the long run. Mistake number 5, never rebalancing. Let's say you start with a smart, diversified $250,000 portfolio, a solid mix of stocks and bonds that matches your risk tolerance. Great start, but 3 years go by and you never touch it again. One part of the portfolio grows faster than the rest, and now your allocation looks completely different from what you intended. Maybe you meant to have 30% in bonds for safety, and now it's down to 12% because stocks ran up so much. You think you have a balanced portfolio. You don't. You have a much riskier one than you signed up for, and you won't find out until the next downturn hits, and it hits harder than you expected. Rebalancing once or twice a year, simply adjusting your portfolio back to your target mix, sounds boring. It is boring. It is also one of the most effective, unglamorous ways to control risk that almost nobody actually does consistently. Mistake number 6, letting emotions drive the decisions. This is the big one. This is the one that has cost investors more money collectively than almost anything else on this list. The market drops 10%. Fear kicks in. Headlines scream about a crash, and someone with $250,000 invested panics and sells everything, locking in real losses on what was, until that moment, only a paper loss. Then, months later, the market recovers, as it almost always does over time. And that same person is sitting in cash, watching the recovery happen without them because they sold at the bottom out of fear. This single pattern, panic selling low, then buying back in high once things feel safe again, has quietly destroyed more portfolios than almost any bad stock pick ever could. The market itself isn't usually the enemy. Our own emotional reactions to it are. Mistake number 7, ignoring taxes and account types. Where you hold your money matters just as much as what you hold. A lot of investors with $250,000 keep everything in one type of account, usually a regular taxable brokerage account, without ever using tax-advantaged accounts like a 401k, a traditional IRA, or a Roth IRA to their full advantage. This means paying more in taxes than necessary, year after year, on dividends, interest, and capital gains that could have grown completely tax-free or tax-deferred instead. Over a couple of decades, poor asset location can quietly cost tens of thousands of dollars, money that simply evaporates to avoidable taxes instead of compounding for your future. Mistake number 8, overconfidence after a winning streak. This one sneaks up on people who are actually doing well. A stock pick works out, a sector bet pays off. Suddenly, confidence goes through the roof, and that confidence turns into bigger and riskier bets, using more and more of that $250,000. But markets don't care about your winning streak. The same conviction that made you money on the way up can wipe out those gains, and then some, on the way down, especially if position sizes keep growing along with your confidence. Staying humble, staying disciplined, and sticking to a plan matters most right after a win, not least. Mistake number 9, no clear plan or time horizon. Finally, one of the quietest but most damaging mistakes, investing $250,000 with no real plan for when you'll need it or why you're investing it in the first place. Money needed in 2 years should not be invested the same way as money needed in 20 years. But without a clear plan, people often mix these together, taking on stock market risk with money they'll need soon, or being far too conservative with money that has decades to grow. Both mismatches quietly cost you, either through forced losses when you need cash at the wrong time, or through years of lost growth from being too cautious for too long. So let's bring this together. $250,000 is a genuinely powerful amount of money. It can absolutely change your financial trajectory, but money doesn't care how hard you work to earn it. It only responds to the decisions you make once it's in your hands. Concentration instead of diversification, no emergency cushion, ignored fees, chasing hype, skipping rebalancing, emotional selling, poor tax planning, overconfidence, no real plan. Any one of these can chip away at your future. Several of them together, and that $250,000 can shrink dramatically faster than it ever grew. Here's the good news in all of this. Every single mistake we just covered is completely avoidable. Not with some secret strategy, not with insider knowledge, but with discipline, diversification, patience, and a real plan built around your goals and your timeline. $250,000 can absolutely be the foundation of real financial freedom, but only if you protect it as carefully as you built it. If this video opened your eyes even a little, hit that like button and make sure you're subscribed, because we're going to keep breaking down exactly how to build wealth the right way and exactly how to protect it once it's yours. This is Ron. I'll see you in the next one.